Let's begin again. My name is Dennis the Professor. I have a fresh piece of chalk. My name is Dennis the Professor. I was so excited about doing this lecture. I forgot to change even shirts. I was just prepared the lecture and I ran downstairs. I was like, I gotta do this lecture because it's really cool. Okay, so we'll be looking at money and banking, right? Another lesson, money and banking. And then in particular, we'll be looking at stock pricing, right? Or how do stocks gain their price and expectations, right? So the important thing to understand here is that in order to be a well-informed financial citizen, in order to understand what is going on in the markets in general, you need to understand some of the fundamental concepts, some of the things that get baked into stock pricing, right? So stock pricing doesn't just happen at random. We'll actually discuss a theory that says that it does and why it has actually quite a bit of credibility as well. But what you'll find is some of the stock movements are predictable. Not all of them, but some of them are. And so today, we'll be looking at primarily how do stocks obtain their value. Now, this is going to be important to you whether you're investing, whether you're considering taking a company public, whether you have a 401k plan that's invested in stocks, right? It'll allow you to see things like business cycles happening, right? And that's going to be very, very important, right? So let's begin with a scenario that's perhaps more relevant, right? So not everyone has traded stocks in the past. So let's just talk about shopping. Okay, I'm sure all of you go shopping for one thing or another, whether it be clothes or food or well, whatever it is, tickets to concerts, video cards, computers, video games, virtual items, it doesn't matter. As long as you're buying something, you are shopping, right? And so let's consider the following, right? Take about 2 minutes to come up with some decisions that you'd rely on in order to choose what you're buying, right? So what are the factors? What are the factors you consider? Factors you consider. So, for example, and I'll start us off here, right? One of the obvious ones is price, right? That's something most people consider when they're buying something. You want the right price, right? So let's try to kind of think of some more. Let's take 2 minutes exactly. In the meantime, I'll look over my lesson and kind of prepare what we're going to do, but what factors are you considering, right? I'll start writing mine out on the board while we wait. Another thing is maybe brand, right? A brand can be pretty important. So if something is very well advertised or very well known, I may be more likely to buy it, right? Access. That could be a big decision point, right? So I can't buy something if it's not in the store. So access is going to be a big deal. What else? We're probably going to be worried about price, brand, access. Personal taste is also going to be important, right? Personal taste. Familiarity. And benefit. Right? So we're going to be concerned with how much benefit we're getting. So for example, there could be a great priced Hershey's bar. I know the brand very well. I can get it at any store I go into. I love Hershey's and I'm very familiar with the taste. However, if I buy one Hershey's bar, I get a great deal of benefit. If I buy 55 Hershey's bars, I get a great deal less benefit, right? Because now that I own the Hershey's bars, I guess I could eat them one at a time, but actually buying them all up front doesn't make much sense when I can just buy them one at a time, right? So if we think about this, right, think about the things that you listed for shopping, and if you've listed some things, feel free to put them in the chat. But if you think about this, let's consider another scenario. And let's consider, this is obviously going to be a fictional scenario, but in our scenario, every single stock price, every single stock transaction is stored on one computer. Stored on one computer. Okay? This computer happens to be in North Carolina, where there was severe flooding, and now this computer is broken. Obviously, this takes some suspension of disbelief, but this is where we are. Now, because this computer is broken, the government has hired you to price stocks. So as I go over it, think it through and see if you can come up with some more analogies to actual shopping, right? So first and foremost, when you consider price, right? The price of a Rembrandt painting is one thing. The price of a chocolate bar is another. Someone who hasn't eaten in 10 days is willing to pay a certain price for a chocolate bar. Someone else who just ate 5 chocolate bars is not willing to pay as much. So what we'll find with price is that price is relative. Right? So if you've ever participated in an auction, you'll know that the price of the thing that you're buying, at the end of the day, it goes to the highest bidder, and that's considered to be its price. So for example, if you're at a car auction and there's a beautiful old Mustang that you want to buy, and someone else is also interested, you guys will fight over the price. So let's say you say 100, they say 200, 300, 500, and eventually they reach $3,000. And let's say you just can't go any higher than $3,000. Not because you don't have enough money necessarily, although that could be the case, but because you believe that it's not worth more than $3,000, right? And so price is something that is settled by a market, right? It's settled through buying and selling of the particular security. And this price is often based on expectations. How well will the company do, right? How stable is the company? How will government regulations and changes in finances or trends affect this company in particular, right? The next thing you want to look at is the brand. Now, believe it or not, this actually applies to stock prices. And the way this applies to stock prices is the following. If you're regularly buying Coca-Cola, right, and you've never heard of this other soft drink manufacturer, Pepsi, right? Pepsi may have better results. They may be in more places, just not local to you. All you're surrounded by is Coca-Cola machines. And so when you're making an investment decision, it's very natural to have a cognitive bias towards what you experience locally and towards what you do on a regular basis, right? And what we find is that investors are actually much more likely to invest in companies that are local to their area, not even to their country, but to their area. So in New York City, companies tend to be invested in that operate in New York City, right? In the middle of the country, companies tend to be invested that operate in the middle of the country. In Spain, the same thing is true, and so it's also true in France and in Italy and Germany, right? People tend to invest in the companies that they're familiar with, and the reason is they feel like there's less risk. They can see this product on the shelf. They can see the service around them, right? Their cousins or their friends or their neighbors are employed by this company, and so they have a natural gauge for what's happening. The next thing, of course, is access. Now, it's very easy to look at a stock like Apple or Tesla and say, well, access is ubiquitous, right? You can buy and sell almost at any time in very large quantities. Not massive. Massive is a little bit more difficult, but large quantities. Thousands of shares, hundreds of thousands of shares even, right? Trading tends to be very high. However, there are many companies that will only have 100,000 shares available. And in order for you to buy it, someone else has to be willing to sell it. And that's not always the case, right? And so there's a liquidity premium on that stock, because if you own it, you may have no one to sell it to in the right moment. And so you might have to reduce the price just to deal with that. right? And this is the idea of access. The next thing is personal taste, and we cover that in brand to a degree. So the branding of a company, whether or not you know them and are familiar, is important to a stock. But personal taste is also important. Now, you may have a background in software engineering, and so you're much more likely to be invested in tech companies because you understand the underlying trends better than someone that has a background in construction, for example, right? That person in construction then might have a better understanding of the building and construction industry. And so when they see things like home prices declining, they know how it's going to impact each one of the companies involved in that process. Whereas you understand how a new innovation or a new programming language or a new development in computers will affect companies like Amazon and Netflix on their ability to distribute data to their users, right? And their bottom line. And so you have a personal taste because you have an understanding in certain industries that is greater than others. The next thing is familiarity. And familiarity falls square in between these two, right? So investors will often make the decision that's familiar, right? That's pretty basic and understood. And then finally, we look at benefit. Now with benefits, you can look at things like stock dividends. So for example, if just by owning a stock, you receive $1 for each share of stock that you own once a year, that's a benefit. And that's going to be priced into the stock because that's a benefit to you. You're receiving that dollar regardless of the performance of the company. You may receive more or less, but most companies that offer stable dividends offer them regardless of performance, right? They're usually very well-established companies. On the other hand, you might, for example, know something, about the company's future, right? This information might be widely available, but because you're a software engineer, you can make the conclusion that Netflix's stock will go up because their costs are going to sink over the next 2 to 3 years as computing power increases. This is also a great opportunity for a benefit, right? And so you have to learn to measure and gauge that benefit and understand exactly what it's worth to you, because at the end of the day, you can't predict the future. You don't know if the company is going to fall apart. You don't know if the company is going to make a bunch of money. All you know is that there is a benefit. So in this fictional scenario, right, we'd be able to look at some factors of the stock. We'd be able to look at the price that was. We'd be able to look at any kind of news that has come out in the past, any kind of economic factors. We'd be able to understand where our investors are and how much capital they each have. Right? And then finally, we'd be able to understand the benefits. What are the benefits of doing this in a specific way? What are the benefits of having a specific stock and holding it, or having a specific stock and selling it sometime in the near future? Right? And so in that scenario, there's actually quite a few things that you can look at, and we'll talk about in more detail what those are. Right? So I wish that I had the technology to do this live with you guys. That's actually very important to me, and that's something we're going to strive for, right? So we're going to do this kind of asynchronously, and with me kind of playing all the parts. However, it should still demonstrate the same idea, right? In the future, we'll be able to do this live, and we'll be able to run these experiments and understand on a deeper level exactly what's happening. So, for example, imagine we have shares of stocks. We have shares. You own some, I own some, everybody owns a little bit of some of these companies. And what we're going to do is we're going to go through various events that could happen in the market and think about how they could impact the stock price. So the first event is matching earning expectations. Matching earning expectations. So what's happening here is that investment advisors have decided that this company should earn X amount of dollars by next quarter. If they match the expectations, then the analysts also attach the price tag. It should hit this price if it does that, right? Now the stock may or may not do that, but in general this is a positive sign. It means that the company, at the very least, if not growing extremely rapidly or the leader in its industry, is predictable. And predictability has a large amount of value in financial markets, right? Another thing that can happen is exceeding earnings. Now, this can be both positive and negative, actually, right? So if a company exceeds earnings, then they did better than what analysts expected, right? If a company does this a bunch of times in a row, you should start to worry about their accounting, right? Perhaps they're cheating the system, right? Because analysts tend to at least predict with some accuracy what's going to happen. If there's constant inaccuracy, then either the analysts that you're following don't understand that business particularly well, right? And there's an opportunity there to make a profit. Or what else could happen is that the company itself is cheating its accounting in order to look more profitable, right? Another news scenario that we could have, and I'll be covering mostly news scenarios, but the reason they're news scenarios is because all economic things end up being in the news anyway, right? At least if you're looking close enough, right? So another one is a typhoon devastates some region of the world, right? Now, any company with manufacturing in that region is likely going to have to stop operations. They're likely also going to have difficulty recruiting new people, assuming that there are deaths or evacuations and stuff like that. If their customers live in that region, that could mean one of two things. If they're building homes and home appliances and the customers are receiving some kind of insurance benefits for their suffering, that could mean a huge boost. If, however, what they build is a luxury product, right, that most people can't afford right away to replace, they're going to see a large dip. And so it's going to affect different companies in different ways. Another example is firing an executive, right? So recently there was a CEO let go for sexual harassment, right? I believe it was by NBC, okay? And this can also be either positive or negative. Now, it's a positive sign for the owners of stock in NBC, right? I believe that's owned by Disney, but it's a positive sign because that means Disney takes its image seriously, right? So before this CEO could do extensive damage to the company, they pulled him out. As soon as they found out there was a problem, they pulled them out. And so we can expect them to do that in the future. On the other hand, if this is a CEO that is very driven, right, is very well connected, and is a large piece of the success of the company or the image of the company, right? Now, the CEO of NBC, most of you would struggle to name him, right? How about the former CEO of Apple, right? Steve Jobs. Much easier to name. Now, imagine if Steve Jobs was fired over sexual harassment allegations, right? Apple stock would take a huge hit, right? Imagine if Elon Musk was fired over similar allegations, right? Tesla shares would take a huge hit because he is considered a pivotal force in that company. Now, he probably doesn't build all the cars himself, design them himself, and do all the engineering work himself. No, he's massive teams that are responsible for it. However, he is a figurehead, and he is a public figure that represents that company. And so there are two ways of looking at this. And what we'll find is that there's usually more than one way to look at any given piece of news. And that's where the buying and selling of prices will happen, right? So another thing is the money supply. If the money supply is increasing, then investors have more money to spend on stocks. If they have more money to spend on stocks, in general, stocks will be increasing, right? The same is true if the money supply is decreasing because you have to liquidate stocks because you're running out of money, right? You're running out of capital. Now, either of these things done in excess leads to inflation, which depresses stock prices, and deflation, which also depresses stock prices, right? So in measure, money supply movements are good, but they always have to stay within a certain bounds. And so where are those bounds? You may think you have the perfect answer, and so does everyone else, right? But you probably don't. And so the market is going to decide where that is. So what's important to understand here is that what you're going to see, right? And we'll cover more market news in a second, but what you're going to see is you're going to see the evolution of stock prices. Of stock prices over time. And what you're going to be trying to do is you're going to be trying to isolate the driving factors. Right? So if tariffs are imposed on the steel industry and then stocks rally across the board, the general consensus is that is positive for the economy. Now, is that true? Maybe not, right? But it does tell you about what the consensus belief is, right? And this is very important. Now, another thing that will happen when you're looking at stock prices is the weekend, right? So very often when the weekend rolls around, markets close. Or not very often, but every single time, markets close. Right? Now there are some startups that are trying to, and some established companies that are trying to inject liquidity into the weekend because it's kind of an outdated mode to just close on Saturday and Sunday, right? But the markets close. And so when the markets close, it becomes very difficult to trade. Difficult to trade. So for example, let's just say you own shares in a certain company, right? And there's some very negative economic news for that company. For example, you own shares in a steel manufacturer that's abroad. On Saturday, steel tariffs are announced. On Sunday, you have to sit on your hands because there's nothing you can do. And by Monday, the stock tanks like crazy in the first 5 minutes, and you're going to have a lot of trouble selling it at a good price. And so the weekend tends to have quite a big effect. And what happens a lot of the time is many smaller investors will liquidate all of their holdings on Friday, just in case something happens over the weekend, and hope that they can buy them back at the same price on Monday. Right? So other positive news can be being declared the best company to work for. Best company to work for. Right? Companies fight for titles like this because it makes recruiting talent a lot easier, right? However, in order to achieve this kind of ranking, you can't just say, well, we're the best company to work for, because you have to offer benefits, compensation, certain perks on the job, etc., meaning you have to incur costs. And in this scenario, you can imagine if you're the best company to work for, the costs are probably worth it, right? Unless you're buying everybody Lamborghinis, in which case it's not, right? However, if you're the 7th best company to work for, it's questionable whether or not those costs are worth incurring, right? Now, you might find a way around this, and you might be the number 1 construction company to work for and the 7th overall, in which case you could still cash in on that benefit, right? But if that's the only benefit you're seeking, that's not necessarily everything, right? Furthermore, companies can suffer downgrades. Now, when a company is downgraded, that means it's unable to borrow debt at the same level. So if it used to borrow at 5%, now it's forced to borrow at least 7%, which means that the number of projects they're able to undertake. So in the past, let's say we had a project, so this is borrow, right? And this is project. So let's say we had a project that was earning 8%, right? Here we would be making a 3% profit. That same project, after the downgrade, would only net us a 1% profit. Now, if you're lending money to the company, you're well compensated. But if you own the stock, you're not. If you own the stock, you receive no compensation for this. As a matter of fact, all future projects are going to earn 2% less money in order to compensate bondholders. And so again, it might be a good opportunity if you still believe in the strength of the company to move out of its stock and into its bond. So other things that can happen are obviously tightening in the money supply, right? You can have more positive or negative economic news. And you can have more positive or negative company news, right? But here's the thing that's important. Whether or not it's positive or negative economic news, whether or not it's positive or negative company news, right? What matters is the interpretation, and the distribution of the news, right? So let's say you own stock in NBC. Let's just say NBC has stock, and I'm not sure that they don't. I'm pretty sure they're owned by Disney, but let's say NBC has stock, and before anyone else knew, your friend came to you and he said, they're going to fire that CEO. I know because I saw it on an internal memo, right? Now, that's insider trading, so not as good, right? So you probably don't want to trade on that because it's illegal, right? Now, let's say, for example, that you follow this CEO on Twitter, and he comes out on Twitter and he says, I regret my decisions and I wish NBC all of the best. I hope that they find leadership that is more equipped, right? So they post this on Twitter at 11 a.m. By 12 a.m., right? So this is Twitter. By 12 a.m., there's a press release, right? All the journalists are working very hard, by 12 p.m., there's a press release. And at 1 p.m., there's an official article about this, right? And so if you were the first to trade around 11 a.m., you'd have an advantage over everyone that found out 2 hours later. And so what that means is you have direct expectations the stock will go down by the time more and more people find out, right? Now you may be sitting and just watching Twitter for this announcement. You may have some exclusive access to a news service that you follow that publishes things faster and analyzes social media, right? Or you could simply be looking for this in the news because you've overheard that this might be happening, right? Or you have an expectation that Disney will behave this way because you understand what their image is as a company and what they'd like to maintain. And so news isn't distributed evenly, right? It's not even distributed at the same time or close to it. As a matter of fact, most of the time news is distributed unevenly, right? People find out when they get home, their stockbrokers call them, it's already 6 p.m., you can only trade the next day, and so on and so forth, right? And so those are just some of the things, right? You can think about economic tax rates, you can think about tariffs, all kinds of impacts that are going to have, right? That are going to be impacting the market. So let's talk for a brief second about valuation. There's a lot of theories on valuation, right? And you can follow every single one of them if you like, right? But they all tell you something different about the company, right? Now, you can look at the company's accounting. And if you listen to Warren Buffett, this is exactly what you want to do, right? This is perhaps the most important thing because accounting tends not to lie, right? The numbers go in, the numbers go out, and that's it, right? Now, you can also follow the news and predict what the impact of the news will be, right? But this is probably the equivalent of a coin flip sometimes, right? Some news can be interpreted one way or another, or other factors that you may not know might tie into this news. And so you better be pretty confident or pretty quick about getting out if the news isn't positive for you, right? You can also look at things like trends. So, for example, more and more media is being streamed live over the web. If you own a company that manufactures DVDs, probably safe to assume that over time, or rents DVDs, right? As in the case of Blockbuster, over time, that's going to be bad, right? Now, there were two companies that rented DVDs, Blockbuster with its brick and mortar stores, and Netflix with its mail distribution, right? And so Netflix was better able to adapt. Now, was Blockbuster not able to adapt? Yeah, you could say so, right? But nobody wanted to invest in Blockbuster. And the reason nobody wanted to invest in Blockbuster, right? So if you were really following this industry, what you'd see is that people weren't willing to give Blockbuster money, because in order for Blockbuster to get into digital streaming, they would have to shut down all their stores. That means firing employees, that means hiring new staff, that means new systems, that means getting rid of all those old leases and winding them down, getting rid of that inventory, etc. Whereas Netflix was already operationally not brick and mortar. They didn't have retail locations. And because they didn't have retail locations, the jump into streaming was a lot easier, right? And that's an important thing to remember, is that those expectations are going to follow. Now, you probably couldn't do this on a 1-year horizon, right? But if you invested in Netflix 10 years ago, you probably made a whole bunch of new friends in the last 10 years, right? You probably made a bunch of money, and it's been a nice time for you, right? Furthermore, you can follow investing trends, right? And this is called technical analysis, right? So technical analysts will tell you the following. When a stock goes up, dips back down but above a certain level, goes back up, dips back down but doesn't cross the level, the odds are better that it will go up, right? So 70%, then it will go down 30%. Right? And there's all kinds of techniques, all kinds of ways of measuring these levels and setting them and deciding where they are, and is there a band up here or a band down there, right? And there's all kinds of complexity that you'll go through, right? But fundamentally, what you're investing on is the mechanics of how people see stock prices, right? So when somebody looks at a stock and it goes up, down, but it's overall increasing, they're more likely to pay more for it, right? Because people tend to predict that what's happened in the past is going to be what happens in the future. But you could be wrong, and that's where the 30% comes in, right? And that's called technical analysis. We'll actually do a more detailed class on technical analysis in the future. But for the time being, that's what you should know. Now, finally, in valuation, right? We talked about the news. Actually, we talked about all the covers, all the factors in valuation, right? There are other ways to value a stock, but at the end of the day, what you're going to find, no matter how you justify the price is still what people are willing to pay. And that's going to be an important factor. Right? Because if people are willing to pay more for your stock, they will pay more for your stock. If they're not, then they're not. Now, you're also going to have expectations. And your expectations are not going to be a constant thing. So you're not going to be, for example, at time 0 and say, well, I expect Netflix to go up, right? And then at time 1, you don't even make a decision. You go, well, I already have an expectation on this, who cares, right? Instead, what you'll find is perhaps at time 0, you'll say, okay, well, gathering what I know and maybe what I use, I expect Netflix to go up, right? Now, Netflix declares that they're going to be building brick and mortar stores, just like Blockbuster. Now you have to revise your expectation. You expect it to go down. Netflix scraps the idea, back up, but not as much, because it's not a good sign when a company is jumping back and forth with ideas. They announce a brand new streaming platform. Great, fantastic, right? They onboard a huge studio, even better, right? More and more people are subscribing. Very good, right? But people's disposable incomes are tightening. Not good, right? And so you see this development in expectations, right? And overall, what the market price is summarizing is the summary of expectations, And what we're going to see is that expectations are molded by a time horizon. So there's always going to be a time horizon. So if a company is generating just quarterly reports, no news, nothing, they're never in the media, expectations will change at those quarterly reports because that's the only time people find out information. If a company is generating news every single day, then expectations will adjust every single day. Right? And this is important because when you look at the price of Apple, for example, the price of Apple at most incorporates expectations for about 1 month. At most, right? When you look at some no-name company, right, that nobody's ever heard of, that just releases financial statements and trades once a quarter by a couple of investors, their expectation is going to be at least 3 months. Maybe longer, it may be like 5 years. Right? So we don't know how well Apple's going to do in 2 years. Why? Because Apple tends to generate news rather quickly, right? And create value in different ways unexpectedly. And so to predict for 5 years into the future, you can only say a broad statement like, I think Apple will overall do well. Great, but that's not a great expectation. Now, if expectations are the things that are forming our prices, right? I don't actually know what I keep doing with my chalk, but I have more chalk, so that's okay. We arrive at a thing called the efficient market hypothesis. Now, this has 3 forms, right? Let's say it's called a weak form, a semi-strong form, and a strong form. Okay, so when you show up to a supermarket and there's 200 brands of chocolate on the shelf, what do you reach for? You reach for the brand that you probably know the best. Maybe you experiment once in a while, right? Now, if you and 200 other people walked in there, right, and you all chose a chocolate, could I then say, okay, well, based on what these people chose, this is the best chocolate? Probably not, because there's no way all of you know all 200 different brands of chocolate, right? And so when the distribution of information is weak, right? If you have a little bit more information, if you know that Hershey's actually uses the best ingredients in the world, and everyone else is just buying some off-brand chocolate, you can buy some cheap, high-quality chocolate. As a matter of fact, if you have some entrepreneurial spirit, you can buy this cheap, high-quality chocolate at a low price, and then resell it to others at a higher price by telling them about the high quality, right? And what you would be earning is arbitrage. Now in this scenario, the only value that you're creating, you're not the one making the chocolate, right? The only value that you're creating is that you're telling people that there is a difference here and that they are unaware of it. And as long as they are unaware of it, you can earn this. Now over time, everyone in your town will know which chocolate is good. And so your arbitrage opportunity will disappear, right? So first, let's assume that all of your neighbors find out. Now, when your neighbors walk in, what they see is they see, okay, well, Dennis sold me this great chocolate, and I know that it's very good, right? And so when I walk into the store, I'm buying Hershey's from now on. I'm not buying these other brands because I know that it's high quality and I know that it's a good price. Right now, some of your neighbors are also entrepreneurial. So what they'll do is they'll take this opportunity to hoard this nice, high quality, cheap chocolate and sell it to everyone else in the neighborhood. Now this information is going to spread much faster than if you were doing it alone. And when it does, we'll reach a strong efficient market hypothesis. Everyone in your neighborhood will be buying the highest quality chocolate at a cheap price because they know about it and they know that it's better than what they were buying before, right? And so what we can do is we can look at this scenario from the market perspective. Now, if you have information, let's say from Twitter or from some other public but not as well used source, like a company blog, for example, that not everyone follows, you might be able to trade on that information. If you're very smart, you're going to trade ahead of the market. So you're going to assume, okay, the market will think this is a bad thing. So what I can do is I can sell a bunch of shares ahead of time and then buy them back when they're cheaper later in the day. If it's semi-strong, then information is distributed well, but there are still arbitrage opportunities. So there's still people trading at 6 p.m. in the evening. There's still companies that are restricted on what they can buy and sell, that have their hands tied on the decisions they can make. And then finally, once your whole neighborhood knows, we're in a strong form market. And so what that means is the arbitrage opportunity is gone. You no longer have an opportunity to make money just off of the fact that other people don't have the information that you do. Now, we're never really in a strong market 100%, right? Because information just doesn't travel that way. Not everyone has all the time in the world to follow strong information, right? Most of the time, we're in a semi-strong scenario. But all of this is going to change from company to company. So again, that company that trades once every 3 months and has an obscure little blog on its website, it's probably in the weak form. You can probably get ahead of a lot of investors. But the thing is, your arbitrage opportunities aren't going to be great, because who are you going to beat? 2 or 3 investors, right? Apple might be in the strong form because everybody follows their news. Everybody follows what they're doing. The media covers it. Everybody covers it, right? The news covers it. And so they tend to be in the stronger form, right? Now, if in that small company, it's actually you and like 4 other investors, and they all look at the company blog very closely, we're back to the strong form. And so the tendency, as you can see with the chocolate example, is that we move from weak form to strong form quickly. Right? We move there as the arbitrage opportunity, because the arbitrage is really free money. You didn't buy a factory, you didn't build a chocolate store, you didn't have to pay for branding or packaging. You're really just making free money. You're buying it at one price, you're selling it at a higher price by educating people on the quality, right? And so the tendency tends to be, when these opportunities come up, is that more and more people get involved, right? The skill gap for doing this is very low, right? So when people get involved, over time, the markets become strong. Right? And so that's our efficient market hypothesis. And it'll be important when we're judging some of the decisions and some of the price impacts that news have on the market. I don't actually have my chat pulled up. I should pull up my chat. Hey everybody. Welcome to the stream. Okay. Obviously, if you guys have any questions at any point, feel free to ask. Be more than happy to answer questions. Okay, so that's our efficient market hypothesis. The next thing that we're going to look at with markets is a random walk. So what the efficient market hypothesis basically summarizes is it tells us, okay, well, all information is incorporated at different amounts and different levels into stock prices. And so when you look at a stock price, it already contains most, if not all, of the available information about the stock. The competing theory for this is the random walk. And this is what a lot of risk is actually based on, right? And the random walk basically says that the movement of the stock price is random. It's absolutely random. There's no logic to this. There's no anything, right? It's absolutely random, and so it's completely unpredictable. It's completely unpredictable, right? What you're going to find is there's actually a lot of truth to this, right? So when you look at an economic event, and when it's unclear whether that's positive or negative for the company, when it's even more unclear what investors will think and how it affects the company, and when you start looking at all the different scenarios, right? So we're talking about economic events, we're talking about company events, we're talking about internal papers, we're talking about accounting, we're talking about different regulations, right? We're talking about things that are happening abroad, we're talking about how much money investors have, how much are they making on a regular basis, what their incentives are, so how much are they able to take home if they make good trades, and so on and so forth. When you start to look at all of these factors, what ends up happening is a random walk is a lot more comfortable to work with. Now, the other great thing is once you assume that the market is a random walk, what you'll find actually is that you can apply distribution mathematics to it, right? So you can look and say, well, the stock can go up and down, and that's distributed on this curve, right? So for example, right, the probability, and it's a little bit fat-tailed towards the bottom, right? So it's a little bit more likely to go down than up, right? But the market can go up and down. 50% of the time it'll do the following. It'll be either here or here, and so on and so forth. And you can see the probability of each movement, right? And so you can start applying math to things like risk and valuation, right? And we'll talk about that in more detail in the risk course. But the random walk theory really does capture the market in a totally different way, right? Now, there's something that I'm personally very interested in that I'd like to cover just in a quick second, right? And this is a branch of mathematics that deals with knots, right? So this branch of mathematics says that, okay, so if you have a knot that looks like this, right, it's got two ends coming out, it's got a loop over here, it's got maybe a triple loop or a quadruple loop, and it's tied in, and all this other stuff that's happening here, right? This might have another loop over here. Basically, this branch of mathematics works with pulling apart what's happening, right? Pulling apart the knots. And by pulling apart the knots, you get the individual strings. And this branch of mathematics is being applied to understand the impact of various news on a stock price, right? And it's actually some success. Now, should you listen to investment advisors? Now, they're called investment advisors by your local banks, but they get most of their information from analysts. Now, for the most part, analysts have a couple of advantages, right? They have deeper access. What that means is that they're able to go to a company and see its books, they're able to see its operations, right? They tend to specialize. So they'll be working in a specific industry, right? They'll be working with a specific sector. They'll be working on a company for 10, 15, 20 years, right? And finally, they have good incentives, which means that they can't profit off of the information or off of the companies that they're rating, right? So they are unbiased in the information that they provide. Now, should you listen to them? Perhaps. Perhaps, right? If you're very experienced in trading in an industry, you might refer to analyst reports to get some extra information. If you're very inexperienced in trading, right, you might look at an analyst report to find out more about an industry, right? So let's say that the semiconductor industry requires a large amount of silicon, for example, right? But you hear that silicon is going to get hit by tariffs. Now, up to this point, things have been stable and happy good, and you just assume that silicon, there's enough silicon and everything's okay, right? But now, all of a sudden, the tariffs are going to impact the supply of silicon to that industry, right? Of plastics and so on and so forth, right? Different metals, for example. And so what you're going to look at is you're going to look at those tariffs and you're going to say the following. You're going to say, well, I don't know much about that industry. I don't know much about how it's produced. I don't know which countries it's coming from or where it's sourced from. So what you might do is you might look at an analyst report at a company that supplies, let's say Intel, with its precious metals, right? Or supplies Intel with its plastics. And you might look at what the analyst thinks the impact will be on that specific company. And then you'll take that little bit of information and apply it to your existing knowledge of Intel. And so you use analysts as a resource. Okay? Obviously, when you just blindly listen to what someone says, you're not going to have very good results, right? But they are an additional resource and an additional source of information. And you can bet that that information is going to be traded on by people, right? Whether they're wrong or right is up to you to decide, right? And you'll vote with your dollars in that situation. But the reality is, they're worth listening to if you're asking the right questions. If your question is, should I buy this stock? Then don't bother, okay? Don't bother because you clearly don't know enough about the stock to be buying it, right? You're not going to make good money overall if that's the question that you're asking of an analyst, right? Now, skepticism. Skepticism. Okay. So let's say you own a large company. Okay, you own a large company, and that company is in a lot of debt. It's got a huge amount of debt. So much so that you need to declare bankruptcy. Okay. Now, your shares in that company that you own as the owner are going to be pretty much worthless, right? And so we'll assume that there's not share disclosure and stuff like that in this situation, just to make the situation easier and kind of easier to process, right? But on Friday, you contact your friend. You contact a reporter, someone you might know or not know, right? As an anonymous source. And what you say is, well, we might be acquired by another company. Another company might buy us. We don't know the price yet, but we think that there's an opportunity for this to happen. So, your source is amazing, right? So the Wall Street Journal publishes this first thing in the morning. Everybody reads it, right? And, your mounting debt and your accounting and stuff looks bad, but I don't know. I mean, the Wall Street Journal published it. It's got some credibility, right? Excuse me. That Friday, you sell the stocks. Now, this is obviously against insider trading laws and stuff like that, and you're actually restricted on how much stock you can sell in these situations. But let's say you sell the stocks. So you sell the stocks that Friday. On Saturday, you're bankrupt. Everyone that trusted this news article is holding the stock, which is now worthless. Right? Now, this doesn't happen quite on this scale, doesn't happen quite to this extreme, but be wary of the news. Be wary of your sources. Be wary of where you're hearing it and why you're hearing it. Right? Because it's going to affect what you're doing. Now, we've already discussed, but it's good to cover good news, right? Your perception of what is good news is different from my perception of what is good news, right? We focus on different parts of the world and on different ideas and different industries and have different passions and different visions for what's going to happen, right? And therefore, good news is not fixed, right? So, for example, let's see the following. We have three companies, A, B, and C, okay? All three companies are based in Southeast Asia. All three companies have equal financial positions. Okay? A typhoon hit Southeast Asia, right? Oh, excuse me. And all three companies are doing housing. I'll just draw one house because, there you go. Right? All three companies are working on housing in this scenario. Right? So on the surface, if you're not deeply rooted in this subject, you'll see, well, the companies are the same. So the typhoon hits Southeast Asia, right? And you expect, this is your expectation versus reality. You expect this price to go down. Excuse me. You expect all three prices to go up. Why? Because when the typhoon hits Southeast Asia, people will need homes, and therefore will build homes. Right? Now what you find actually is that this company is just slightly more popular with the government. And so their price actually goes up. This company is slightly more popular with consumers. This one goes up. Now, all of the capital that went into here and here is now not available for this company. And this actual company goes down. So if you traded on the news, what you would have found is that reality doesn't match your expectations. And the reason is what you didn't consider is that the amount of capital for investment would vary. Right? And so good news, which is why we started this whole piece, isn't necessarily good news for the stock, right? Or the stock price. Now, overall, in 1 year, all of those companies could be back to that same situation where they have the same financials and they're worth about the same thing, right? And if you believe that's the case, what you can do is you can trade the difference, right? So what often ends up happening, right, is this is the stock of, say, McDonald's, right? And this is the stock of Burger King. And sometimes this will happen. And investors will look at this and say, well, fundamentally nothing has changed, right? I mean, there's some problem going on in the market, but fundamentally, right, Coke and Pepsi, I mean, excuse me, you could do Coke and Pepsi, but let's just say McDonald's and the King, right, are far apart, and they shouldn't be. So what they'll do is they'll bet on this stock price going down and this stock price going, this Burger King going up and McDonald's going down at the same time. Expecting what? Expecting them to converge. Right? And so that's a strategy you could pursue in that example, right? But, and we'll talk about trading strategies in the future, but the important thing to note is that good news is not always good for everyone, right? What you'll also find is that people often trade on market fundamentals. Fundamentals, right? So what that means is if you're Netflix, right, and you're producing $1 million of revenue per year, right, and to produce that, you're constantly in debt about $50,000, right? That's your debt to income ratio. Great. Now, if you're Magic Box USA, which produces boxes, and your revenue is $1 million, and your debt is $50,000, the price for these two stocks should be equal. Right? Now that factors out a lot of other things. But for most investors, this is a very solid starting point. Right? Is this understanding of, okay, so if we compare it agnostically across industries, just as a way to generate money, right? Pretty straightforward, simple explanation. Just as a way to generate money, if we compare these two, they should be worth about the same. And then we can start to add on little expectations and little ideas, right? But if you're paying for a stock, if you're trying to buy MBU and it costs twice as much as Netflix, you got to think twice, right, about why MBU is so inflated, right? Is it because Netflix is underpriced and you should buy Netflix? Or is it because MBU is too expensive and you should short them, right? So what you're going to find is that market fundamentals are going to guide a lot of your starting points in what you're doing. Now, you'll also find bubbles. Bubbles tend to happen for a lot of reasons. As a matter of fact, I think all of the reasons so far have been pretty diverse, right? But basically what happens is some group, right, let's say tech stocks, in the late 90s and early 2000s are overvalued. Right? Why? Because expectations are out of control. Right? The companies are household names. Everybody's expecting the internet to be the future. All these companies are so innovative. Look, compared to these other companies, they don't need retail space. They don't need anything. They're so light, right? Because people tend to overestimate these things, right? And then they tend to see, wow, it's growing. I should buy more, right? I don't want to be the dummy, right? Look at Bitcoin, right? I don't want to be the dummy. Let me sell my kidneys and buy more Bitcoin, right? So you don't want to be the dummy, right? And so everybody doesn't want to be the dummy. And so what they do is they keep raising and raising and raising expectations. And those expectations become flimsier and flimsier, right? So over time, I mean, you're not saying fundamental things like, well, they have no overhead and they're able to save on workforce. You're saying things like, the internet is the future and people will buy all of their pets online, right? And that's just not the case. That's just not the case, because even if it is the case, that's such a ridiculous prediction. Like, who are you to be able to predict something like that? So, expectations drive out of control and cause bubbles. Now, it doesn't necessarily have to be expectations. You can have capital injections and things like that flying out of control. You can have inflation flying out of control. It can be a lot of different things, and we'll actually spend an entire class on bubbles, right? But the final step that we should talk about is behavioral finance. Excuse me, I have check the time. Okay. Is behavioral finance. Now, behavioral finance teaches us the following. Behavioral finance teaches us that people are imperfect. And what you may be saying to yourself is, Dennis, I'm pretty sure we all already knew this. Yeah, I know. I know we already know this. But when you went to go buy and sell stocks, were you thinking about that? Were you thinking about that the people trading them are imperfect? That they might underprice things or overprice things? Yeah, right? So it's important to understand why, right? So that you can avoid those mistakes. So the first thing is loss aversion, right? So let me ask you a simple question, and we'll spend actually an entire class on behavioral finance because there's so much to cover, but we'll cover the surface level right now, right? So for loss aversion, right, let's say I gave you a 50-50 shot, right? 50% of the time you would earn $100, 50% of the time you would lose $100. Would you play this game? Probably not, right? It's a net zero. Okay. What if I gave you $101? Right? Math says that you should play this game because overall you'll come up $1, right? But your brain says no because you're not trying to lose $100. For what? For possibly making $1? It doesn't seem worth it, right? But the math says that it should work. And so this kind of thing has people doing the following. When a stock is rising, and let's say you bought here, all the way up to here, at point 2, you've been making money. Now you haven't cashed that out because you haven't sold the stock, right? You've been making money and making money. You're like, wow, my portfolio's worth so much. This is like an extra month of income I made this month, and so on and so forth. And it's great, right? And you attach all of these ideas. Well, I'm going to spend this on a vacation. I'm going to put it in my kid's savings fund. I'm going to put it in a college fund. I'm going to put it away for retirement. I'm going to buy a brand new boat. Whatever. I'm going to go on a fishing trip. I don't know. I don't know what you spend your money on. But let's just say you have all these plans, right? And then suddenly the stock starts to decline. And you start to say, well, I'm just going to wait it out. I'm just going to wait it out because, you know, I still could have gotten a boat. I still could have gotten a boat, and I'd probably get a boat if I could. Right? But the stock's starting to go down, and it's starting to go down some more. And now you're like, well, you know, if I sell it, I'm only going to make a very little amount of money. I'm just going to hold it for longer, right? And then the stock keeps going down. And now you're at a loss. Now you're at a loss, and you're saying, well, I don't want to sell the stock. If I sell the stock, then I've lost money. I don't want to lose money. I'd rather have the stock, right? And then eventually the stock is bankrupt. You've lost all your money, right? But this loss aversion, this idea that people would prefer not to lose money over making money, is literally the basis of the insurance industry, right? Insurance would not exist if this were true. If this weren't true, there would be no insurance companies. Why? Because nobody would buy insurance. What are you saying with insurance? I'll pay you $100 a month, okay? No problem. So that once a year you can pay out a claim for $1,000. But that once a year I don't lose the $1,000. Right? That's how insurance companies make money. They make money off of this idea of loss aversion. Now, I mean, there's societal benefits to insurance companies, but loss aversion is a very real thing. We'll actually do a whole class on insurance as well. The next thing is overconfidence. Overconfidence. And this is very similar to like gambler's fallacy and all that kind of stuff. And basically the idea that you're seeing, it is live. Hey, how are you? Pleasure. The idea that you're seeing is that you will become, or you are, overconfident of your abilities, right? And so here's what happens. You buy the stock here and you say Netflix is going to go up. No way, they're going to beat out everybody. Okay, great. So you've made this prediction, and you're correct. Wow, Netflix went up. You must be a genius, right? And so you go and you tell your friends, hey, man, I think Netflix is going up. Yeah, I think it's going to keep going up. And then it goes up again. And all your friends come to you and say, holy shit, dude, I can buy a fucking boat. I can repaint my house. I can do all this stuff with this money that you made me. You're brilliant, man. You know what you're doing, right? And so what do you do here? What do you do here? You go, oh, well, you know what? I think Netflix is going to keep going up. Okay, sure. So what do? You take your house and you mortgage your house. Probably not a great idea, but you mortgage your house. And people were doing this in the 20s. People were doing this. They were mortgaging houses. They were selling everything they owned to get into the stock market because they were so confident about the fact that it was going to keep going up. Right? And then the stock takes a dump. Just dies. Just huge losses across the board. Right? And your overconfidence led you to overinvest in that stock, to put too much money and pay too much for the shares. Right? And this gets caught up like contagion across the board. Right? The people that are most likely susceptible to this actually aren't investors that trade on a regular basis. They're people that jump into the stock market when things are really hot and really good. Right? I will bet you the following. And if you go to r/Bitcoin, the majority of the people on r/Bitcoin on Reddit are people that bought somewhere around here or here or here and are currently holding something worth that, if they're still holding it, or they sold it at a loss, right? Because most people that are trading are going to be dummies. And the reason they're going to be dummies is because they don't act on information when they first have it. So they receive information. Wow, Bitcoin might be a technology of the future. Great. I'll wait for everyone else to buy in and see how they do. Oh, wow, my friend made that much money. Wow, my cousin made this much money. Oh, my God, my brother made that much money. Wow, I should get in. Okay, I'll buy in too. Oh, wow, I've made a little bit of money. Okay, I should hold on because, I mean, this is going up. Some of my other friends have bought in, and all of my dad and my relatives have all bought in. Okay, great. And then it takes a dip. And the reason is you were just too confident of your ability to predict the future. So remember, and remember with absolute purpose, that you cannot predict the future. If you can predict the future, buy the lottery. Much better, much easier to win, much more money usually. Don't worry about it. Just buy the lottery. You don't need all the money in the world. You just need a lot of it. And you'll have a lot of it if you just buy the lottery and win all the time. Right? But overconfidence is a killer. Oh yeah. Yeah, Bitcoin was a freaking mess. Bitcoin was a mess. People were promising impossible things. People were running scams. There was a real mess. And the reason is overconfidence, right? Overconfidence, both in themselves and in the people that they're trusting for financial advice. Remember, the people that you're trusting for financial advice should either have an incentive that aligns with what you want, right? And should have a very extensive background. And a background means the following. Let's imagine two people. Let's imagine a professor. And let's imagine an investor. Now, you might say that a good professor teaches at a prestigious university, teaches a complex subject, teaches to students at the master's level or the PhD level. Sure, right? So what we're doing is we're stacking positives. Okay? If an investor comes to you and all they've had is success, steer clear. Steer clear. There's one exception called Renaissance Capital. But even they will first tell you about their failures, why they made them, and they'll always inform you in detail of the risk that they're taking. Right? So when people were investing in Bitcoin had something like the following going on when you were doing an actual analysis of prices. Right? It wasn't that Bitcoin had 50% chance to go up, 50% chance to go down. No. Not at all, right? That would say, okay, that's great, right? So Bitcoin could go up or down, right? But it could go up and down maybe $10. Sure, that's not a huge price swing, right? But the confidence for this was like 2%. Which means that the actual change could be $1,000 in either direction. That's all we knew. Right? And so the variation of your results would have been ridiculous. Right? Now, obviously, you can flip a coin 25 times heads, and we'll talk about, there was quite a bit of insider trading happening at the time, right? And we'll talk about all the different things that happened there. But in this situation, the only thing that was happening that was most important was that people were too confident that the past is a good predictor of the future. If the past was a good predictor of the future, right? There's actually a great quote about this that I really like, right? So Henry Ford was asked, on his invention of the automobile, right? He was asked, about consumer confidence and consumer surveys, right? Whether or not they went to consumers and asked them what they wanted, right? And what Henry Ford famously said is that if I had asked people what they wanted, they would have told me that they want faster horses. Right? And that illustrates the fact that people take what exists around them and say, well, I want it to be better, or it's been increasing over time, it's bound to increase forever. Right? It's not going to. It's not going to. And people are short-sighted. They don't remember 30 years ago. Right? And if they do, we as a population, we'll discuss this more in behavioral finance, we as a population tend to eliminate bad memories over time. So we tend to have rosier and rosier memory of the past. And that's very dangerous when you're investing in stocks, because stocks don't happen to care about what you think. And then finally, and this really ties into overconfidence and Bitcoin, is social contagion, right? And what happens with social contagion is stock prices rise because other people are buying them and other people are buying them and so on and so forth. And what you're doing is you're passing on this hot potato, and the last person stuck with it is the person stuck with it. Does that happen when money runs out? Maybe. Does it happen when there's bad economic news? Maybe. Maybe it survives some of those shocks. Maybe it doesn't, right? But the fact of the matter is, chasing these trends can be a very dangerous game to play, right? Because the thing is, gradual increases tend to happen, right? But drops tend to be far more drastic, right? And so your ability to sell somewhere along the line here is very, very low. As a matter of fact, usually prices stabilize somewhere way below, and you're actually able to liquidate your stock, because the more prices are going down, the more people are going to the market and saying, okay, I want to sell. Quick, let me sell as much as I can, right? And so what ends up happening is this social contagion effect happens in both directions. When it's increasing, people are more hesitant. They have to put money on the line. But when it's decreasing and they're starting to lose money, they want to get out and get out and get out and get out, right? And when they want to do that, you get really rapidly depressed prices because not a lot of people are buying. The best time to buy? Right here. Right? Unless you think bankruptcy is on the corner. In which case, don't buy right here. But that's your best time to buy. And so, when you're considering stock prices, the main rule of thumb is that you're seeing expectations. And that some of those expectations are going to be based on behavioral issues. Some of them are going to be based on things like proximity to the company and familiarity. Right? People trade Google because they know Google. Right? How many people do you know that trade Baidu in America? Not many. The reason? They don't use Baidu. Baidu a worse company? Probably not. Right? But they don't trade it because it's far away. So you're looking at behavioral factors, proximity factors, you're looking at fundamental factors. You're looking at behavioral, I already said behavior. You're looking at fundamental factors, you're looking at technical factors. Right? You're looking at all kinds of distortions. Right? You're looking at all kinds of distortions, and all of these distortions together produce a price. Now, if I told you to sit down and untangle these things, right, it would probably take you a lifetime. If that, you probably never, it hasn't been done yet. No one's figured this out yet, right? That's why we study finances. No one has figured this out. So then the easiest assumption to make that works most of the time is that it's random. There's a probability for up and a probability for down and a probability for left and right, and you can factor in some of these things to skew the randomness left or right, and we'll talk about that more when we discuss programming in R and statistical modeling. But your basic assumption is that the price of the stock is random, and when you assume that, it's very different. And so you might say, well, if the price of the stock is random, why should I invest? You should invest based on the fundamentals of the company. You should invest with a long-term outlook. You should invest if you feel particularly strong about the news. You should invest if you think that people are getting caught up in a contagion and that the prices are going to sink very fast. Or if you think that's just what happened, right? You should invest if you look at the technical charting of the stock and it looks interesting to you and you look like it looks like it's going to keep going up and you've read some books about that. You should invest if some major economic news comes out that's going to hit oil prices or soybeans or something like that, right? You should invest not to make a profit, right? That's what you're trying to get to in the end. You're trying to earn some money and so on and so forth. But you're not investing to make money all the time. What you should be doing when you first start investing is you should be testing ideas. You should be testing elasticity. You should be understanding, right? And when you approach it in that way, you will make a lot more money. And the reason you'll make a lot more money is that when you jump in and you say, okay, you know what? The technical analysis tells me this is going up. In the next 5 minutes, if it doesn't go up, I'm selling because then I was wrong. That's when you can admit that you're wrong. That's when you can learn from your experiences. And that's when you'll actually start earning profits on your investments, right? When you're able to cut losses. Most people are unable to cut losses. Most people stick to their idea and say, yeah, but I still think it's going to do this. You might be right. How long do you have to wait? You have to wait 10 years for a 5% increase, you've lost money. Right? So test your ideas on the market. Explore behavioral finance. Explore ideas of proximity and familiarity with companies. Explore fundamental analysis through accounting and explore technical analysis, right? Explore price distributions, right? And see if they follow the patterns that you're expecting. Refine those patterns. And we'll actually dedicate classes to these individual pieces. That's how much there is to this. That's how much there is to this. We'll dedicate entire classes and tools and so on and so forth to learning how to do this, right? But when you look at a stock price now, it's not that simple, is it? It's not just because there was a great announcement on Twitter. It's not just because there was some economic tariff. You realize that there are other pieces. And what you're starting to realize isn't necessarily why the price is the way it is. Right? You're starting to realize why other investors think the price is the way it is, right? Why other investors are deciding that that's the way things are going, right? And things are a lot more complex than they seem on the surface. But once you understand that, you can start digging through that complexity. And digging through that complexity is what finance, and in particular the markets, are dedicated to. All right, that concludes our lecture for today on stock pricing and expectations. If you guys have any questions, feel free to put them in the chat. I'm just going to switch to a different scene so I'm not just standing in front of the screen. I'll be incorporating more and more activities into what we do, right? So more case studies, more exploratory examples where the chat participates and kind of says, okay, well, this is what I would do, and this is maybe what you would do, and so on and so forth. And so we're going to be breaching this discussion. We're going to be growing it into a more cooperative process, right? Where we work together to discover and to tailor things. So if this is your first time here, make sure you follow the stream. You can follow me on Twitter as well for the announcements. All the lectures are posted on YouTube, usually the same day, sometimes the day after, so you can catch up or review anything you missed. And yeah, thank you very much for being here, and I wish you all a great day. I'm going to leave the stream on for another minute or two just to see if people have questions. I'll be muting my mic, but I'll jump back in to say anything. If you guys are here also for the first time, or if you haven't answered this question in the past, tell me what you're looking to learn. Tell me what you're looking to find out in these classes. Tell me the knowledge that you're looking to gain, how you think you want to apply it, whether it's investing in stocks, whether it's just becoming a better financial citizen, whether it's building your own company or one day running a large enterprise, whatever you think that your goals and the way that you're going to apply this, share it with me, because that allows me to tailor my lessons to what we do. So having said that, thank you very much. I don't see any questions in the chat. So I wish you all a great day, a great evening, a great morning, wherever you are, whatever you're doing. Thank you for joining me, and I will see you all tomorrow.